If you're in Economics 53, this is your last lecture of the year. This is also my last lecture, but not just of the year, of my entire career. This is the last lecture after 46 years of teaching and approximately, by my guess, 6,500 lectures. I intend to continue to post videos and the like after I retire, mostly for alumni, but this is the last formal lecture that I'm ever going to give. It's time, I guess, to move on. We're going to cover here the second set of lectures on fiscal policy. In this group, this is a more complicated lecture and it's a little longer. I didn't have time to split it up. We talk about entitlements, Social Security, Medicare, and trust funds. So let's get into that because this is going to go on for a while. I'm going to begin by quoting from my book. I wrote this book, red ink right here, in 1990. It was published, I think, in 1996 and 1997. It was about the budget, deficit, and debt of the U.S. government because I was concerned about the state of affairs, even though that was 25 years ago. Let's see what I had to say in that book. In the investigation of any aspect of human enterprise, we seldom get very far before we encounter either a budget in some form or a crisis explained by the lack of a budget or by disregard of budgetary discipline. The ultimate constraint upon our consumption of goods and services is imposed by a budget that is capped by income and access to credit. Think of how differently we would all live without such constraints. Although it would not be in this world, budgets exist because both financial and real resources are limited. The business that ignores the financial rules of cost control is a doomed business. Although governments have more latitude for financial excess, ultimately financial strength is a necessary prior condition for political and military strength. A lesson discovered by the Soviet Union in the late 1980s. Over time, no regime can endure without good books, and the numbers are indifferent to the politics. No political stance nor ethical imperative, whether liberal or conservative, can override the need to keep the books in order. Resources and programs cannot be paid for with lofty declarations, with the best of intentions, nor with moral righteousness. Just cash. Maybe cash borrowed rather than cash taxed, but only up to a point. So that's the underlying theme going into this lecture and our general discussion of fiscal policy. Also from the same book, there's a little segment where I discuss some research done by the man who was Ronald Reagan's first budget advisor. His name was William Grider. He quit the Reagan administration when he saw that the Reagan administration was going to run large deficits. He wrote that the most important function of the federal government is mailing checks to citizens. And by that he meant Social Security checks, pension, welfare, veterans checks, checks to hospitals and doctors for medical care, and checks sent for a host of other reasons. When Grider wrote that in 1981, such disbursements equaled 48%, basically half of all outlays by the federal government. Now, 80% of all checks written by the government are to individuals. $3.63 trillion payments to individuals, consisting of these components down here in the pie chart: Social Security, medical care, need-based public assistance, interest on the debt, federal employee retirement, unemployment, student assistance, and smaller payments to individuals. The portion of the budget, the entire budget that is dedicated to non-payments to individuals, such as the Department of Justice budget and the Department of Defense budget, is that wedge that is pulled out there at 22%. Only 22% of the money that is spent by our federal government is something other than payments to individuals. In case you're curious about what the category of need-based public assistance is, that's broken down to these three general areas that we normally think of as welfare. Housing assistance is $50.1 billion. Food and nutrition is $101 billion. Public assistance is $195 billion, although that portion of the budget is relatively small. As you can see, Social Security and medical care take up the lion's share of the federal budget. Now let's introduce ourselves to a new concept, entitlements. I need to go through this carefully because you do need to understand what this amounts to. With an entitlement, the law extends a financial right to the general population or some cohort in the population. That implies an ongoing legal financial obligation of government, ongoing over the years. Therefore, outlays over time of entitlements programs are determined by two things: the original law and any amendments to the law, and usually by demographics. Now, for an example, Social Security is an entitlements program that was created during the Great Depression. There are no annual appropriations for entitlements. There is no direct budgetary control for entitlements because, again, the amount of spending is determined by the actual language of the law, any amendments made to the law, and by the demographics of the targeted cohort. Examples are Social Security, Medicare, various need-based programs of the kind that I just described, and federal pensions. So those are good examples of entitlements and comply with what we're requiring here for a budgetary outlay to be called an entitlement. So what is the connection to trust funds? This is the first mention really of trust funds. Now this is a little complicated, so I'll go slow. This is one of my original slides that dates clear back, I think, to the early 1990s. I've just kept it all these years. This was actually prior to red ink, I think. Federal trust funds are established as a bookkeeping entry mechanism largely, where money flows into the trust fund, either as money specifically earmarked for that trust fund, as is the case, as we'll see, for Social Security, or simply from normal tax sources, and in the jargon of the budget, that is referred to as federal funds. And that trust fund also spends money, called outlays, and therefore the trust fund, because there's an imbalance between money flowing in and money flowing out, at least in the early years, the trust fund balance will grow. So the trust fund balance is all surpluses less all deficits, and a surplus for the trust fund and the trust fund only is receipts minus outlays. So in other words, again, if receipts exceed outlays, and they always do in the early years of the trust fund, then the balance grows, and the balance is equal to the sum of all of those surpluses until this arrangement changes after, in some cases, many years or even many decades. Now, we'll look at some examples of trust funds, and so you'll see what I mean by this kind of construction. But again, let's take a look at some generalizations. It is really nothing more than a sub-account within the large unified budget of the United States Treasury. The word unified budget in this context means that the United States Treasury basically runs the budget for all of the agencies as a sort of super agency. So a trust fund is like a checkbook within a checkbook. If, for example, if you have your checking account at Bank of America or Wells Fargo, there's nothing to keep you from keeping in an internal account for your checking account that shows the amount of money that you care to dedicate to auto repairs. You can simply run an internal little book that shows you're effectively dedicating, say, $50 a month from your general income that goes into your checking account to auto repairs. And when you make an auto repair, then you write the normal check you would write anyway, but then you debit that account. And so this is how trust funds work for the federal government. The revenue sources, as we've already said, are both internal and external, meaning in some cases, and as is the case as we'll see, for Social Security, for Medicare, and for disability insurance, they have dedicated resources from specified taxes. Other trust funds have internal financing from the Treasury simply passing cash into the trust fund. The balances held by a trust fund, remember we said they have a balance, is held as non-marketable United States Treasury debt. So when they run a positive balance and the trust fund balance grows up over time, that balance is held in the books as interest earning non-marketable Treasury debt. Now we need to pause for that because we haven't said much about this category. So let's divert to that discussion to make sure you understand it now. Now we've been looking at the tally of marketable debt for the United States Treasury on a number of occasions. We've been looking at bills, notes, bonds, and talking about how they're financed and how they're important to the government. And we said in the very last lecture that there's a difference between the gross debt of the United States and the net debt of the United States. And I pointed out that the net debt of the United States is more relevant as a number that represents the amount that our Treasury owes to people outside of government, including us, foreign holders, and all of that. That category of debt we called marketable debt. But we said the difference between gross and net is another category called non-marketable debt, and I promised to explain it at some point. Now is the time for that explanation. If you look at the top of this slide, you can see the bills, notes, and bonds as represented before. Sometimes the values are representing the conclusion of a different month, so it may be a little bit different than another slide I showed you. This was for the amount outstanding ending in December 2019. That's the most current. That came out of the March 2020 U.S. Treasury Bulletin. But now we see this non-marketable category at $6 trillion. And within that, we see this large government account category of $6 trillion and $14 billion, meaning adding up to a total public debt, including all of this, of $23 trillion, but a net public debt, which we defined earlier as the external debt, as only $17 trillion. Well, this government account is trust fund balances, such as the balance in or held by the Social Security Old Age Survivors Insurance Trust Fund, as we're going to see. So when we look at Social Security, when we look at Medicare, when we look at disability insurance, and others that we're not going to cover in this lecture, we're going to see that they earn interest on something. And what they earn interest on is their holdings of these non-marketable but interest-bearing United States Treasury securities. So you might say, well, are they a special kind of security held in specific denominations? The answer to that is no. They look just like U.S. Treasury bills, notes, and bonds, at least in terms of their description. They earn an array of interest just like bills, notes, and bonds do. They have different maturities just like bills, notes, and bonds do. The only difference is that they are an internal bookkeeping convention that pays interest, which means in effect that the party that owes the money is the United States Treasury, and the party that the money is owed to is, for example, the Social Security Trust Fund. So the United States Treasury passes an interest earned into the trust fund every year, as we're about to see. So again, they hold these balances in interest-bearing but non-marketable, can't be sold outside of government, are mere bookkeeping entries that never leave the government's books. Government debt, non-marketable government debt. So let's continue down our list. Trust funds, if they're externally financed, like Social Security is, and we'll see that Social Security is financed by the payroll tax, then if that fund is running a surplus, that is to say, if the dedicated taxes going into the system are greater than the outlays for the system in any given year, which has been the history of the Social Security system since it was established in 1936 up until last year, then the fund surplus reduces the unified deficit. But if the trust fund starts running a deficit, then it adds to the overall budget deficit of the United States Treasury. That's an important point that we'll come back to. If the trust fund is running a surplus, because of the cash coming in is just given to the Treasury, although the Treasury makes a bookmark back, in the form of interest-bearing non-marketable Treasury debt, but that money then can be spent by the Treasury. So if the fund is running a surplus, the overall budget deficit of the U.S. government is reduced by that. But if this fund is running a deficit, then the overall unified budget deficit is increased. Interest earned, as we've already said, is internal and basically a bookkeeping entry, and it's absolutely nothing else, as we'll see here when we get to this. So these are 4 elements that we need to remember about trust funds to understand them. Now, I've made it clear that when these trust funds are started, the dedicated receipts will often exceed the outlays for not only years, but literally for decades, as is the case for the Social Security system. That's why they are financed that way. These systems are designed to be very, very long-lasting structures because, of course, again, we're talking about Social Security and Medicare, among other things. However, over time, sometimes, and in the case of our government right now, the trust fund balances are gradually being depleted. And so we need to talk about this relationship here. There are 3 critical inflection points for trust funds over their lives. Now, first of all, take a look at the mapping of the red line, which is outlays by that system, compared to the blue line, which is receipts by that system. And our trust funds have more or less been designed to operate along those lines. When they're first started, we have time, of course, and time is measured in decades, literally along the time axis. When these funds are first started, as for example, when Social Security was first started, everybody paid taxes into Social Security from moment one, but only a relatively small number of people were able to draw from Social Security in the early years because they had no balance built up. Over the years, however, these lines converge. When they converge to point 1, that's when outlays exceed receipts. At this point, the trust fund is adding to the budget deficit when we get past inflection point 1, where the red arrow is pointing. If it's in that area where the red arrow is, then this trust fund is still running, but outlays from the trust fund are exceeding receipts, and this is adding to the overall budget deficit. Step 2, when outlays exceed receipts by more than interest earned by the trust fund, because remember, they do earn interest on their non-marketable debt, at this point, the trust fund's balance begins to decline because even interest earned is not able to grow it. And so you can see the balance mapping on the bottom related to inflection point 2. And then finally, all important, when interest earned goes to absolute 0 and trust fund balances are depleting, then spending authority technically is eliminated. The program that the trust fund sponsors is not supposed to spend anymore. Now, of course, that isn't going to happen to Social Security and Medicare. They won't stop spending altogether. But when we get to, as we'll see, point 3, they will have to curtail their spending considerably. Now, the reason we're introducing all 3 of these inflection points for our federal trust funds is because we're moving through them right now, as I'm going to show you. During my lifetime, and certainly during my own parents' lifetime, we were far to the left of this graph where the blue line was way above the red line, and these trust funds were accumulating huge balances because of tax receipts that far exceeded their outlays. About 2 years ago, the Old Age Survivors Insurance Fund got to inflection point 1, and so past that. And the Hospitalization Insurance Fund for Medicare some time ago passed 1 and now is past point 2. So that's why I'm introducing this concept. Now let me quote again from my book right here, because this is about you. Now here I'm describing college students graduating in 1996, not college students graduating in 2020. College students graduating in 1996 will begin paying, as soon as they find work, 7.65% of their earned income into 3 federal trust funds, and their employers will make a matching contribution. And of course, that's still true. These students will be expected to make this contribution and possibly more through the 45 years or so they are employed. One of these trust funds, the Medicare Trust Fund, is running a deficit for the first time in 1996 and is expected to run out of funds in the year 2006. Now, I wrote this in 1995. The largest share of taxes goes to the Social Security Retirement Fund, currently running a sizable surplus, which contributes to a large fund balance presently. By current projections, the retirement fund will begin running a deficit around the year 2012, and fund revenues are expected to be exhausted in the year 2031, about the time these students turn 55. Now, that was written in 1996, and it wasn't my projection, as we'll see. It was a projection of the trustees of the Social Security Trust Fund. I simply read that, and I agreed with them. I say down here in the bottom that since this publication, the date for the fund deficit changed to 2018 and has already happened, and exhaustion has been bumped up to 2035, in 2015 and current as of 2 days ago. And this year, I probably should have changed this note on the bottom, didn't. This year, the fund's balance exhaustion has been lowered to 2034, as we'll see. Now, here's what we're saying about Social Security. It's a funds in, funds out system. Even though it's a system that is designed to provide effectively retirement income, I'm currently drawing on Social Security, for example, and I have for years. It is self-funding in the year in which the outlays take place. It is not a sinking pool of investments like a private 401k account would be. As you prepare for your private retirement, if you're using a 401k, then you set aside a certain portion of your income all through your life, and you buy income earning assets like stocks to pay for your retirement. The Social Security system doesn't work that way. It's funded as a cash in, cash out basis every year. As we say, funds in from the tax source, funds out to outlays, and when it runs a surplus, that goes into the trust fund. And as we say here and before, this again is one of my really old slides, this is held as interest earning non-marketable debt. So that has been the picture of the Social Security Trust Fund since 1936. Now, what is the dedicated income that these trust funds have? Well, remember in the last slide, I apologize that I didn't have the payroll tax slide current. I just skipped over it. I forgot to go back and change it. So here it is, and I've modified it slightly. The trust funds run by the Social Security system consist of two trust funds, old age survivors insurance, and that's what you think of normally as the retirement fund that your grandparents, for example, might be using, and disability insurance, which provides disability income to people who document that they have disabilities. And as you can see here, when we go break this down, the old age survivors insurance funds itself from a payroll tax upon you of 5.3% of your income every month or every time period you get paid. And your employer matches that amount for a total of 10.6%. If you're self-employed or entrepreneurial, then you have to pay the entire 10.6%, and that goes to the retirement fund. The disability insurance portion of it, you pay an additional 0.9%. Your employer matches that. If you're self-employed, you pay 1.8%. The two trust funds for Social Security have an income cap currently of 2020 of $137,700 for both being employed or self-employed. And so any income you make above that isn't taxed. It's cut off at $137,700 for those two trust funds. Additionally, you pay 1.45% to Medicare, and your employer matches it. If you're self-employed, you pay 2.9%. I'm supposed to be following this down here with my arrow, and I forgot to do that. So the total tax you pay for your payroll tax comes to 7.65%. Your employer makes a matching contribution. If you're self-employed, unfortunately, you have to pay 15.3%. So no matter what it is, what status you are, whether employed or not, then you're going to pay about 15.3% of your taxable income. It's actually the case that you pay 15.3% of 107.65% of your taxable income if you're employed. So that is, in a nutshell, where all of the funding for Social Security and Medicare come from. So let's take a look at the actual trust fund itself. And we'll go through it slowly, then we'll look at a few more. This is the account of the Old Age Survivors Insurance Trust Fund. You can see there I typed out Old Age Survivors Insurance inside the inset. That's what the OASI stands for. Now let's read what I say about it, and then we'll track down how to read this document. So this one is still running a very tiny surplus, but is running a cash deficit because interest earned, which is a bookkeeping entry only, exceeds the surplus. And so this puts the trust fund in region 2. So this means that the trust fund is no longer mitigating the overall deficit. It is now contributing to the budget deficit on an annually growing scale. And in 2018, the trust fund ran a cash deficit for the first time in history. And this is the 2019 document. Now let's look at it and make sure that you understand it. We begin the beginning of the year with a balance, such as the balance you have in your brokerage account or in your stock account or your retirement account. And so this trust fund works the same way. And then the trust fund has sources of receipts, and you can see that by far the most important is the FICA tax, which I've just described. It's almost entirely the source of income for the trust fund aside from interest. And you can see those taxes contributed $767 billion to the trust fund as funds flowing in 2019. This trust fund, because of the interest-paying non-marketable debt that it holds, also earned $79.8 billion in interest. There were some other receipts that don't amount to much in the scale of this. So total receipts for the Social Security Trust Fund for 2019 capped out at $897 billion. And then, of course, we have the outlays. The outlays consist almost entirely of sending out Social Security retirement checks, such as the one that is sent to me every month. The retirement payments for that fiscal year came to $889 billion. Total outlays wasn't much more than that. The Social Security system is regarded as a very efficient system that doesn't take much overhead. But when you take a look at the receipts and the outlays, then you can calculate that they had a slight surplus that was almost balanced budget, 0.1, so $100 million in a huge budget. But they had a cash surplus or deficit of minus $79.7 billion. Because to calculate the cash surplus or deficit, you subtract the interest earned from the U.S. Treasury, because that's a mere bookkeeping entry. And so therefore the contribution of the Social Security Trust Fund to the budget deficit was almost $80 billion this year, even though 2 years ago it was zero. Then we end with the ending balance. Oh, shouldn't have gone so far, sorry. Then we end with the ending balance of $2,801,000,000. Now, when we say ending balance, that, of course, is the non-marketable interest-earning Treasury debt that this trust fund owns, on which it is going to be paid a little under $80 billion in interest earned next year. So that's how all of these trust funds work. So this one, of course, will last for quite a bit longer. We're saying, in fact, that it will be depleted in the year 2034, 14 years from now. But it is running a deficit at the present time. So when we go back and summarize why the OASI Trust Fund is in Category 1, because we said outlays exceed receipts, and At this point, the trust fund is adding to the deficit because we don't count the interest earned, because that is not actually a cash value coming into the Treasury. So we're at point 1 now with the Social Security Trust Fund. We're past inflection point 1. Now, a few things have been done to try to keep this trust fund healthy, because you remember in red ink I said it was projected to run out of funds earlier. This is one example, and this is probably the kind of trick that will be used to keep the trust fund going as it approaches 2034. So as I say here, in 2011 and 12, there was a new obscure entry called the General Fund Payment for Payroll Tax Holiday. And that's because they reduced the FICA-SECA tax for a short time because of the depth of the recession we're experiencing. Of course, that cuts substantially into receipts into the trust fund, so they simply arbitrarily made a bookkeeping transfer called the Payroll Tax Holiday of $96 billion into the trust fund, which bolstered its balances back up. This sets a precedent for arbitrary pumping thin air entries into these trust funds, in my opinion, and so you can make them limp along simply by making bookkeeping transfers from some other area of the Treasury, perhaps indefinitely. But of course, as they say, that's kind of a slippery slope. But there is a precedent for this, and I'm showing it to you right there. Now let's take a look at the much smaller disability trust fund. And I won't need to go through it in detail like we did on the first, because now you know how these work. This trust fund had a balance at the beginning of the year. It was actually larger at the end of the year, so they clearly ran a surplus of $850 when you take outlays and subtract receipts. Of course, they had a cash deficit again because of the interest earned, of the receipts, I should say, interest earned was $2.9 trillion. So this trust fund is also past point 1. But this trust fund was in serious trouble up until 2016. And again, we can see the solution that was arrived at to make this trust fund more solvent. So this is an old slide from 2015. And I write on this, in this scandal-ridden trust fund for disability insurance is 2 years away from level 3 inflection point, causing the trustees to say this. And so this is in the trustees report. They say, however, the disability insurance trust fund reserves become depleted in 2016. So take a look, for example, at the surplus, the yellow, and the cash deficit, the yellow. I mean, the surplus is actually negative, so it's a deficit. And you can see this trust fund is pulling down its balances very rapidly. It's running it has $41 billion in balances, and it ran a deficit of 28. So this trust fund is doomed within 2 years at the end of 2015. So they said at 2016, this trust fund would not be sufficient to pay 81% of benefits. Therefore, legislative action is needed as soon as possible. Then they wrote in blue, lawmakers may consider responding to the impending DI trust fund reserve depletion as they did in 1994, solely by reallocating the payroll tax between OASI and DI. Now, of course, another thing they might have done is reform this corrupt system, because the disability insurance system is rotten to the core. But God forbid they do that. Instead, we did a little bit of a sort of gum and baling wire. And so basically that's what they did. They did exactly as the trustees recommended in 2016, changing the allocation of the payroll tax as shown below. But I'm adding something actually that shows it more clearly right here. This is the payroll tax for the split between old age survivors insurance and disability insurance from 2015 to 2019. You can see in 2019, it's back to this is the combined tax of employer and employee, 10.60 and 1.8, which is where it was in 2015. But in compliance with the recommendation made by the trustees of the fund, they changed the OASI to 10.03 and the disability insurance to 2.37. And they continued that through 2016, 17, and 18. And it did provide a fix, as we just saw a moment ago. The trust fund looks relatively healthy today. However, this, of course, shortens the life of the much more important and much larger old age insurance fund. That's why the estimated fund depletion estimated for that fund has now dropped to 2034, because it basically is, as say the old saying, robbing Peter to pay Paul. And Peter, in this case, is the Old Age Survivors Insurance Fund, which received fewer tax allocations because of this move, this desperate effort to save disability insurance trust fund without actually reforming the system one whit. And you probably weren't even aware of this. Practically no one is aware of this in the United States. Let's take a look at the rather sad Medicare Hospital Trust Fund, which is on the brink of disappearing. This hopeless trust fund, this is basically the Part A of Medicare Trust Fund, is well into Region 2 and heading for Region 3, contributing to the current overall deficit and is barely scraping by. You can see the balance is going down. The balance is only $200 billion or so. Interest earned now isn't very much because the trust fund balance is so small, and the interest earned comes to $7.1 billion, and therefore I think the calculation I have for the deficit, is that correct? Oh yes, it is. It's not. It's coincidentally. Yeah, coincidentally, it's the same as the interest earned, but that is only a coincidence. So this trust fund is running a deficit of $7 billion, and it's running a cash deficit, contributing therefore to the federal budget deficit of $14 billion. I don't know if I said that right. It's running a deficit of $7 billion, and it's running a cash deficit of $14 billion, contributing to the unified budget deficit of that amount. Now, of course, as we say, that puts the hospital trust fund in the category 2 region. So where are all these numbers coming from? Well, this is coming from a document that I read every year. I scan read it because it's 300 pages long, but it's a very good document put together by a bunch of extremely competent government actuaries called the Board of Trustees of the Federal Old Age and Survivors Insurance and Federal Disability Insurance Trust Fund. All of this comes from that document for the largest part. And so they say in the document that was published just a couple of months ago, under their intermediate assumptions, the cost is projected to be this and to be that. So you can read it if you want to on the stationary slide when you're done. But the only thing that really matters is this right here, where they say Old Age Survivors Insurance Trust Fund reserves become depleted in 2034. So for you, that's going to be around the time you're, say, 30 or 35 years old or so. And then the Disability Insurance Trust Fund reserves become depleted in 2065. But that's not something you care about. Now, as it says just below, last year's projection was to the fund would be depleted in 2035, so it's lost 1 year, and it lost 1 year partly because income was diverted to the Disability Trust Fund. So where do they get these numbers from, and why is that document so long? Well, first of all, in that document, there's the cover of it right there. It's just a big PDF file, or you could get it's a cheap paper version of the actual trust fund itself. They make actually 3 forecasts. And what we normally see in the media, when the media rarely talks about any of this, is the intermediate forecast, as it says, if you're looking right there at the top. So the 3 forecasts are a low-cost, best-case scenario, which uses a mix of economic assumptions that will give you a low-cost option. The intermediate, which is the one that's mostly publicized, the one that, in fact, over the years has turned out to be very accurate, and the one that we see, and a high cost, which is the worst case scenario. Now, the book I wrote was based, I mean, in the book I discuss all three of these because they've been doing this forever, but the book I wrote made its projections based upon their intermediate forecast. And of course, in the book I gave them credit for what they did. Now, here's a list of assumptions they make, and later in the slide set we're going to talk about specifically what some of the key assumptions were that enable them to forecast how much money the system is going to be spending, how much is going to be taken in taxes, and what is going to happen to the trust fund. On the demographic side, they use comprehensive statistics on fertility, mortality, the immigration rate, the population size, and life expectancy. And the economic variables that they forecast for these three sensitivities are productivity, inflation, average earnings, real wage freezes, labor force size, unemployment rate, real GDP or real GDP growth, and interest rates. So this is a very polished, comprehensive forecast. It's done, in my opinion, very impressively because, again, what they were saying in 1995, in which I said, I'll repeat that because I believe it, generally came true. Now, the trust fund did run out of money as early as they had forecast because certain changes were made to prevent that from happening. Now, this is effectively what they're saying. Now, you may recall that we said that the spending authority is eliminated when the trust fund runs out of funds. That's not really the way it's going to happen. Here's what they're forecasting will happen about the time my students in 1995 are just thinking about retirement, and you yourself are maybe age 35 or so. They see the step decline in scheduled and payable benefits from the level that is projected to that flat line. And that, of course, is because of the depletion of trust fund reserves. And so they have estimated how much the fund, without using a trust fund, can pay out in benefits after trust fund depletion in 2035. Now, given that the benefits were supposed to climb, this, of course, has the benefits largely capped at a much lower level. And so if you look at 2035, it's basically a loss immediately of about 20% of benefits, and it converges slowly over time to a loss of about 27 or 28% of benefits. So the trust fund won't disappear altogether, or I should say more importantly, the old age survivors insurance fund won't disappear altogether, but it will be diminished. And this, by the way, is the joint combination of the disability and the survivor's insurance. The impact upon survivor's insurance alone is more severe than that shown here because the disability insurance trust fund remains healthy because of the budgetary transfer that I described a couple of slides ago. So although these benefit combinations will be down only 20%, the payout to retirement will be down about 25%. So then they ask, what would it take to fix this in the document? I always quote that. Now, what I have here under if the steps are taken now is from this year's, and what they said last year is from last year's. So let's take a look at this year's. And it says revenue would have to be increased by an amount equivalent to an immediate and permanent payroll tax increase of 3.14%. to 15.54. Now, they're only talking about their component of it, and so that would be a sizable increase in the taxes you would have to pay because it rises, as it points out here, by 3.14%, and on top of that, scheduled benefits would have to be reduced by an amount equivalent to an immediate and permanent reduction of about 19% applied to all current and future beneficiaries, or about 23% if the reduction was applied only to those who became initially eligible for benefits in 2020 or later. Does that make you feel confident about how much money you're likely to earn on Social Security? Now, last year, they said, what happens if we wait until the funds are depleted? And they say, well, an increase in revenue by an amount equal to 3.65 percentage point payroll tax to 16%, with a reduction in scheduled benefits by 23%. So basically, given that I'll be long gone by the time this becomes a problem, probably. Basically, my generation is stealing from your generation, effectively, because this is a cash-in, cash-out system. It is not a sinking pool fund of any kind. And so cash that you're paying in, or people just ahead of you are paying in and you're about to pay in, is at a very high rate. There's proposals to increase it by 3%, but nonetheless cut your benefits by as much as 23%. It's being proposed by the trustees. It isn't going to happen. They're just going to ignore this until 2035. And of course, I continue to collect outsized payments for my contribution to Social Security over the years. I figured out in red ink that my mother's generation was really rewarded by Social Security. She was paid out, mother and father. Father wasn't on it very long. He died kind of young. They were paid out from an actuarial point of view, a very high rate of return. My generation is being paid a fairly high rate of return. It's as good as you would get in probably a well-managed 401k. Your generation is going to have, because you'll be paying higher taxes for lower benefits, and your taxes are not for you, your taxes are for me, you'll be getting effectively an unfair distribution. Now, this year, I was surprised to see that they just gave up on this. They stopped writing this stuff. They said, if steps are taken when funds are depleted, if actions are deferred for several years, the changes necessary to maintain Social Security solvency become concentrated on fewer years and fewer generations. Well, who knows why they gave up trying to convince the Congress to deal with it now. Now, life expectancy has a lot to do with this, of course, given the way this fund is established. And so these are their estimates of life expectancy. And this is the life expectancy of someone born in that year for that person. So the life expectancy of someone born 4 years after the Social Security system was established was only 61 years for men and 65 for women. And now it's up to 80 years for men and 84 years for women. So of course this has serious implications for Social Security going out in the future. In my book, I have this graph, the population age 65 and above as a percent of the total, coming from 1950 to 39, and most of that actually came true very close to true. The median age was 39, and the percent of people above 65 is now 20%. And so that means, of course, that over time, as these trends manifest themselves, think about this, in 1950, only 8% of the population was above age 65. By 1990, that was 12.5. By 2030, it's up and stable for a time being at about 20%. So, of course, this means, this is also from the original book, that the ratio of contributors to beneficiaries, of course, has been declining during time, which effectively jeopardizes this system in the long run. Because again, in 1950, very few people were taking out. And looking at the old age survivors insurance only, 16.5 people were paying in to every one taking out. So no wonder the surplus was enormous and growing, given the scale of the economy at the time. It slowed down by 1960, but still 5.3. And you can see that it continues to decline. This was mostly a forecast past 1990 that's largely come true. In 2020, 30, and 40 at numbers like currently 2.3. So this system, which again is self-funded, is not so easy to maintain when only 2.3 people out there working paying taxes for every one person that's actually drawing from Social Security. The trustees have this also in their own document, and this again is the three forecasts, the intermediate being the one everyone uses, labeled number 2 in the middle, and this is the number of beneficiaries per 100 covered workers. Well, if you look at 2 and you go out there, to 2060 or 2070, you can see 50 per 100 means it's only 2 to 1. And if the worst case scenario happens, it'll actually be less than 2 to 1. It'll be 60 of every 100 workers around 2080 or 2090 are covered. So this system has a long ways to go. Now on this again, we have to say back to this, to summarize, when the outlays exceed the receipts and so forth, that we contribute to the deficit. In summary, we have to say that the old age survivors insurance is now past inflection point 1, and as such is therefore, for the first time ever, contributing to the budget deficit. This is now what used to mitigate the budget deficit is making it larger. Medicare, of course, is long past inflection point 1 and is past inflection point 2, and therefore, of course, the Medicare trust fund balance is actually receding. It's for these two reasons that the Congressional Budget Office made this forecast that we looked at, I should say, in the last lecture. Remember, I was comparing the rise in federal debt held by the public because it's likely to go above 100% in the next couple of years, pointing out that World War I and World War II, it was high. World War II, in fact, it was higher than 100% because governments don't use taxation to pay for wars, they borrow, but then, as you can see from the record, they then pay the loan off, which is not something we do anymore. But we took a look at this, and you see the line for 2020, and you see the projection rises wildly, and it's not because of the pandemic, because this was published in January 2020 before anybody knew of a pandemic. It's for what I just explained. It's because the Social Security program and medical care are the top two categories of the federal budget, with defense in there somewhere. But I think defense now is below the overall combination for medical care. Maybe not for Medicare by itself, but combined government medical programs, it's now number 3. And it's because those programs historically, which have been mitigating the budget deficit because their trust funds have been running surpluses, are now running deficits, and that's why that number goes straight up. Not because of the pandemic or not because of any underlying current economic assumptions. Now let's take a look for a moment at the variables that drove those projections. I'm certainly not going to expect you to know this, but I think you might find this interesting. This is actually kind of a crude summary because the work they do is very sophisticated, and they get right down to the last detail on how they estimate it. So these references down there on the bottom, if you care to see the work that's put together for the long-range demographic assumptions, is found there, and as I say, it's extremely detailed. I had to average in some cases, or I had to choose a select year in some cases, because for some of the assumptions they make a different value of the assumption for every year, and others they don't. So here are the more important ones, like the fertility rate, net migration, productivity gains, consumer price index, and the intermediate is the one I think we want to look at. The worst case scenario is something we don't even want to contemplate. So, for example, the fertility rate that's assumed for the intermediate is 1.95. Well, the current fertility rate is 1.68, which is actually below the worst case assumption, because basically the higher the population growth rate, the slower that ratio of retired to not retired goes down. And so a declining fertility rate works against these numbers, and the current is actually worse than the worst case scenario. The immigration rate, the current immigration rate, I don't know where they got that number from. I would have guessed it would be smaller than that, but I'll take the number they have. The intermediate's a little bit better, or not as good as the current. And the higher the immigration rate, the more it helps for the same reason. Again, you have a contributing labor force. And so that doesn't hurt us very much. Productivity gains, of course, were nowhere near the intermediate level at 1.19, and also we're below the worst case scenario. The CPI annual rate, inflation actually helps here. That's way below the intermediate case now at 1.66, way below the worst case. And the unemployment rate was the one bright spot in all of this, because the intermediate case requires an unemployment rate of only 5.5, and we are, quote, currently at 3.7, except we're not currently at 3.7. That's the 2019 number. That number is going to go probably to 18 to 20%, and although it will come down, it'll come down after only a period of time has passed, and so even that now is not being very helpful. Finally, the intermediate case assumes a interest rate earned by the trust fund, so that's effectively a Treasury rate anticipation of 2.3%. Currently, the real interest rate on Treasuries is minus 1.5 because, as you know, the nominal market rate for all Treasuries except for 30-year bonds is below 1, and the underlying inflation rate up there is, say, 1.5 or 1.6. So the real interest rate is maybe minus 0.8 instead of 1.5, but basically I'm estimating for this year at minus 1.5. And so again, we come nowhere near. So there's no reason to believe that we'll ever achieve the best case scenario, and that was actually true in 1995. The numbers didn't look like they were something that we could accomplish. The question is, are we going to be able to avoid the worst case scenario? Now, their own graph of how this all works out compared to mine, where I show it sort of fanciful, is shown here in the black for the largest part. Because we don't care about the disability insurance program. Very few you will apply for it. And in fact, under the most optimistic scenario, it shoots way off and generates a surplus. So of course that could be used possibly for the old age survivors insurance. You see all three scenarios peak out before now, and the plunge into no more trust fund in those 3 date points right there. So you'll see the one labeled 2 is plunging in at 2030. Now the scenario 1 is the most optimistic. That's where they assume a high fertility rate of 2.15, which is way above what we have now. High immigration, high productivity, low inflation, low unemployment. And so even with that, it would run out of funds at about 2045 or so, but we're not going to hit that. The current intermediate projection, therefore, has it going in at 2034. And in 2010, this estimate was 2037. And that's because partly, again, they deferred some of the funds over to disability insurance, but also the economy is not matching up to the assumptions values that need to be hit for the intermediate value to be realized. So there's a real possibility that something a little closer to scenario 3 could actually be our fate. And so that's why this picture doesn't look very good right now. It means a lot for you personally. Those funds will be paying benefits, but basically from an actuarial point of view, you're paying way too much into it for the benefits you're likely to get out, and the benefits are likely to be reduced below what I'm getting right now, for example. But also these trust funds, the worse they get, the more they contribute to the overall federal budget deficit. So this leaves us with a few questions we have to ask. First of all, how will these deficits be reduced? And here I'm talking about all of them. How will the deficits within the trust funds be reduced, if that's possible, and how will the unified budget deficit be reduced for the budget as a whole? How is this going to integrate with Federal Reserve monetary policy? Because right now the monetary policy is to some degree monetizing the deficit, but you can't monetize the deficit of this scale forever. Otherwise you turn into Venezuela. Will Social Security and Medicare be fixed by any sort of reasonable standard? I don't think the answer is yes, because this was already being pointed to as a potential crisis when I wrote this book, and that's why I wrote it, and that's why the book sold reasonably well, and they didn't do anything in response to the crisis 25 years ago when it would have been much easier to fix. They used basically gum and baling wire and Band-Aids when they need to be doing open heart surgery. And the current Congress does not have the wherewithal to do anything other than engage in pointless partisan battles. So until that gets changed, I can assume that you need to figure out some other way to finance your retirement. Does any fix imply inflation? That's the $1,000 question. We can fix it kind of by having a hyperinflation, because it basically reduces the actual value of our U.S. debt, right? huge. $23 trillion gross, $17 trillion debt outstanding. One great way to put that down to a more manageable level is to have a couple of hyperinflationary episodes. Now, of course, you pay the price for doing that outside of the debt, but it does fix this problem. Students are always asking me, do you think that there's inflation in our future? And I say, well, if I'm talking to young students in your future, I think beyond any doubt there is. There's none in the immediate future like this. Will future medical costs be met? And because the most damaged of these systems is Medicare. And the trust fund we looked at, of course, was just the hospitalization fund for Part A. But nonetheless, medical costs are the fastest rising category of costs in this economy. We learned that weeks ago, or even months ago, actually, when we took a look at the Consumer Price Index. And will this arrangement be fair is the final question we have to ask. And for you, the answer is no. There's no way this arrangement is going to be fair. I think it's very unfortunate. This is one of the reasons why, over the years, I was so dedicated to teaching Economics 104 and tried to lasso as many students into that class as I could and teach it to the broadest base. Because if you've had that course, you remember the relentless drumbeat coming from me. You have to arrange for your own financial security, and you have to do it wisely with at least a minimal knowledge of how these finance markets works, so you can manage your 401k and your IRA and your retirement accounts, because believe me, nobody out there is going to worry about you and your retirement. You're going to have to take care of it for yourself, and so while you're doing that, you might as well also take care of it for your family. I'm glad to have been teaching Harvey Mudd students who are receptive to this kind of message, so I think that in most cases, you'll be able to do exactly that. You'll be able to take care of yourselves and take care of your extended family by simply using prudent investments and realizing that these programs that nobody understands and nobody knows where they're going are simply not going to be sufficient for your own retirement future. Here's some key takeaways that you should understand. I'm actually going to post the quiz for this right after I post this, because that quiz becomes available at midnight tonight on the day that I'm live streaming it.